over the last few weeks. And I'd like to just round out Chapter 5 by talking about, I guess, where the Tax Act is gray, or just give you an example of where a taxpayer may have some discretion, and just talk about whether it's really tax evasion or tax avoidance. Then I'd like to talk a little bit about that after-tax cost of capital that we talked about the other day, and then the lease versus buy decision on an after-tax basis. And then finally, I want to show you an example of a tax loophole. We'll talk about why a taxpayer may want to arrange his affairs this way, and talk about whether or not it really should be legal. I mean, the loophole, so it's legal initially, should the government shut it down, and see what the value is and why someone finds things that way. So the first example I want to talk about really is about the expense versus capital asset side of things. And this is a farm, and the fence around the farm basically has deteriorated, and they need to fix it up. A farm is a business, so it's a money-making venture, and therefore they're treated not like a personal hobby farm, but like a business. And the farmer has two options. They can go out and buy a new fence, $48,000, or they can repair the old fence. Okay. Now, repair, restoration, usually very labor-intensive, and cost of labor is fairly costly these days. And so it actually costs more than basically putting up a new fence. So the answer, obviously, in Chapter 4, where we're doing it before tax, where life is easy, well, you're going to basically put up a new fence, and you're going to save $2,000. And, you do the thing that sort of makes sense. So, before tax, that's the answer. After tax, it's not necessarily so clear. If I put up a new fence, now think about it in terms of whether it's an asset. Well, it's something that helps the farm do their business. It's something that's physical. It's something that's going to last a very long time. It's a necessity. And I mean, it's really a capital asset. So if I put up a new fence, I'm going to have to figure out what the after-tax cost is on the basis of depreciating it. Right? It's a long-term asset. Well, I need to know the CCA rate. And so if you go into the textbook, you'll find that fences are in Class 6, and I have a 10% rate. And if I want to find out what the after-tax cost is, let me just use a simple formula here. You know half your real formula. So for tax purposes, you have to use the much longer one. And the after-tax cost would be what? Well, $48,000 times CCTF, the capital cost tax factor, which is 1 minus TD I plus D. Well, that factor is 0. And so it would cost $38,400. Okay. So that's the cost of the new fence after tax. But what about if I, or the farmer, decides to repair it? And the contractor says, well, we're good at repairing fences. It's going to last as long as a new one, right? But it's a repair. Well, a repair is an expense item. Right? We're not buying something new, right? We're repairing something. So we get to write that off right away. Well, from our formulas, after-tax cost, before-tax cost 1 minus T, then all of a sudden, it sort of flips the decision, or the recommendation. Well, 1 minus T is 0.6, and so it costs $30,000, which seems to make no sense at all. Right? So, the Chapter 5 answer, the after-tax answer, is repair. And save $8,400. Just the treatment, capital assets versus expense items. Yeah, please.
Just in the bracket in the question, is that 1 minus TD over I plus D?
Yeah, this is TD, I plus D.
Okay.
Yeah. It's a standard capital cost tax. No half your rule. The other one's much more complicated.
If you're repairing something, aren't you adding to the value of the asset?
Yes, but the issue is, are you creating new value, or are you just maintaining the original value?
I think depreciated the whole fence all the way through it.
Yep. But the point in law is that if it's not a capital asset if I'm not adding value. Okay. So right now I'm doing an elevator modernization at the college, which you might think is a repair. But we're putting in new access control, we're putting in energy efficiency savings and a whole new type of technology controlling the fence. That's deemed to be adding value to the building, I can depreciate it. If I just fixed it by taking the motor out, putting a new motor in, that's a repair. Okay. So the question is it sort of new? Is it adding real value? In this case, we're just fixing it. We're making it as good as it was before. Okay. So we get to expense it. Well, of course, the farmer doesn't want to repair it. The farmer wants a new fence. But after tax, he's being told that that's not the right thing to do. Well, why don't I perhaps say, well, I really want a new fence, and I'm going to make it look like a repair. What about if I leave one post up from the old fence and put a new fence all the way around? Is that a repair? Because I got one old post up. No. What about half a dozen posts? At some point or other, it's not totally new. It becomes a repair. What's that point? Well, that's up, I guess, to the tax auditor who comes by. Declare it to be a repair, and the entire farm is a shiny new fence when you're getting audited. Well, he may not think that it's a repair and disallow it. So the gray area really is, how do I make this look like a repair? Well, perhaps if I do a third of the fence a year, and I'm saying I'm repairing a third of the fence a year to go around, put it through the books as a repair, that would probably work. But, tear everything down, put up everything brand new all at once. That's definitely a capital asset, and you're going to pay more. Okay. So you want to get some advice from, your basically tax accountant when you're looking at this in terms of how I structure it. Because, I'm basically it's going to cost me $8,400 more if I don't do it correctly. And so we try to use the gray area or ambiguity whenever we can. And we always try to expense things whenever we can. Simply it comes as well. Okay. So probably what would happen is, a portion of the fence would be repaired as good as new over time. And that would suffice probably to repair, and you get to stick up. Okay. Now, what about if the farmer isn't profitable? Does that make any difference? Well, if the farmer isn't profitable, and let's say the farmer's decided to put in a new fence. Well, if the farmer's not profitable, then he's not paying taxes, and therefore depreciation has no value. Okay. And let's see, what if I sit here? Unprofitable for 3 years. So if he's not making any money for 3 years, how does this change? Well, he's going to have to wait for the tax savings, and therefore, one would think that the after-tax cost should go up. Okay. And so the tax savings are going to be starting in year, unprofitable here, so he's profitable in year 4, and so I'm going to start getting tax savings here. Okay. And he's buying the fence end of year 0. Okay. Well, if I want to identify, well, what are the tax savings associated with buying the fence? I can use this formula. TF, the tax savings from CCCF, basically is 1 minus CCCF. Okay. So really it is that factor up there, CD over I plus D. Okay. So the first thing to do is to figure out, well, what are the tax savings? Okay. And that formula tells me one time period before the first tax saving occurs. So first thing to do is to say the tax savings on the $48,000 is going to be this factor here, which happens to be 0.2. So the tax savings are $9,600 at this point here, end of year 3. Okay. And of course, he's buying it at end of year 0, and therefore he's got to wait 3 years. Okay. And so I'm going to then say so this is tax savings end of year 3. The tax savings end of year 0 will simply be then P given out. In this case, it's 10%, common 3 times 96. Okay. And so they are reduced because he's got to wait. Right? And then the after-tax cost of the asset, ATC, is going to be the $48,000 minus the tax savings, $72.13, or $40.77. and the cost has gone up because he's got away from the tax savings. So just remember that the tax savings basically is the one minus the capital cost tax factor, right? The capital cost is 0.8 of every dollar. And the tax savings, of course, then is the 0.2. Okay. Any questions? Okay. So again, we're going to be aware of whether a company is profitable, and then try to play games where we can to make sure that we can expense as much as we can. Okay. So why don't we'll just leave that up for a second. Why don't I talk a little bit about the after-tax cost of capital. And that's really a function of interest being deductible, and it changes from Chapter 4 to Chapter 5. And the approximation, so the after-tax cost of capital is basically going to be, first part that changes is the fact that any interest is tax deductible. And therefore, I'm just simply going to use that after-tax, before-tax formula to come up with what is the cost after tax. So this is simply recognition that after-tax cost is 1 minus T before tax. And when I pay my dividends, I'm paying it out of after-tax income, right? So I don't get to deduct it. I mean, that's what I'm trying to calculate in all of this. What's the after-tax cash flow? Well, that's what I pay the dividend out of. So when I pay my dividends, it comes out after tax money, and I don't get to deduct it. Okay. So what we'll see here is that the cost of capital in the after-tax world is less, the interest is deductible, and indeed there's a preference for more debt than there would be before tax, simply because it's cheaper. And that, of course, affects your optimal debt-equity ratio. Okay. So this is what we use basically in Chapter 5. And I want to show you an example where there are two ways of handling a project. We're talking about cash flow analysis, and you might say, well, we should include all of the cash flows. Remember that when we borrow the money, we're going to pay interest, and interest is a cash flow. But up until now, we really haven't bothered much with the financial charges. And remember when we came up last day with this formula, net operating income after tax, keyword being operating, 1 minus T, revenue minus costs, or expenses, plus BTS, okay, in any particular year K. The keyword being operating in that there are no finance charges in there, right? We're looking at operating the business and not worrying about the financial charges. All of the financial charges are basically, when we discount it, the cash flows at K. That's the normal way of doing it, the preferred engineering economics way. But if you want to include all of the cash flow, let's have a look and see what the interest does to the project. Okay. Now, this is, I think, just a summary of what we talked about in Chapter 2, where we have cost of equity, cost of debt, cost of equity higher because, of course, the risk to the shareholders much higher than the company's debt holders. And, we basically have dividends or share price increase, which we've talked about in terms of the cost to the company, that notion of dilution of ownership. And on the debt side, a lot easier to understand. You borrow money, you pay interest, you pay it back. Okay. In this particular example, let's look at it this way, net operating income, and let's include explicitly the actual financing costs and see whether or not we get the same answer, and which makes life easier. In this particular company, 50-50. Probably a little high as far as debt equity is concerned for an engineering company. But using these numbers, the cost before tax is 14%. Okay. The cost after tax, again, this deductibility here, assuming that they're paying a 50% tax rate, 40%. Sorry, a 40% tax rate, I should say, is basically 12%. Okay. This is an approximation. This really is an internal rate of return type of equation, and the actual answer is 12.8. But as long as the bond is 10, 15, 20, 25 years long, the approximation is very close to the actual real number. In this case, the bond is 10 years, so there's about 0.8% difference. Okay. But for our course, this is a good enough number. Okay. So $1,000 worth of interest expense before tax cost the company $600. So let's have a look at this project and analyze it two ways. The net operating income way, where all of the financing charges are explicitly included in the actual cost of capital. Don't have to worry about it. Okay, we're doing our engineering part, we're just worried about operating this project. This is a photocopier where we're buying it, we're keeping it for 10 years. And just to give you an example of what straight line depreciation looks like, of course the photocopier would be capital cost allowance, but I've just set this up, so we're going to depreciate it for tax purposes, straight line. Remember, we can do that for franchises or other intangible type projects or assets. If I do that, I'm basically saying I'm going to depreciate it to zero over 10 years. And so I've got a $10,000 depreciation charge. Okay. So what normally I do is I buy one of these and I get rid of a lot of small printers throughout the company. Large printers have lower impression costs. They also, per volume are much cheaper. And so there's savings associated with us of $40,000. Okay, my printing costs go down. That, of course, is savings. It's not really revenue or profit, but since it does affect my bottom line, my taxable income goes up, and the government wants 40% of those savings. So even though I'm doing this on the company's initiative, the government shares 40%. And so after tax, there's $24,000 left savings for the company. Okay. Then buying that machine, of course, you have $100,000 and zero salvage value at the end assumed, and this depreciation charge. Okay. Well, DTS, this is depreciation tax saving of $4,000 a year. Okay. So fairly straightforward analysis. I'm buying the machine, salvage value is zero, and I'm netting $28,000 a year in terms of benefits. At the cost of capital, my project worth $53,000. It is a good project. So that's the way we normally do it. That's the net operating income approach. Okay, and we're just using the formulas to value things. Okay. Now, what about if you said, well, this is a cash flow analysis. Let's include all of the cash. And because the company has a 50-50 debt equity ratio, when it buys this machine, it's going to go to the bond market and sell a $50,000 bond. Right? That's how it's going to finance half the project. If I want to then explicitly include all of the financing, then what I need to do is I'm going to buy this machine, say $100,000 for a Xerox machine, and then I'm going to sell a bond, so I get $50,000 coming in from the sale of that bond. It's a 10-year bond, so I'm going to have to pay it back 10 years from now. So that's the minus 50 at 10 years from now. And then operating exactly the same, except here I'm going to have to pay interest, and I want to explicitly show that. And so if it's, it was a 10% bond, I'm paying $5,000 a year interest, $3,000 after tax. So here I've included all of the financing charges. And so my after-tax cash flow is a little different because I've got operating minus the finance charges, so it's 25. Okay. And so I can value this just like I did before. But the question now is, what is the interest rate? What is the discount rate? Well, if I now look at that minus 50, okay, so let me net out the end of year zero. Okay. So I'm spending $100,000, I'm getting 50 from the bond, and therefore there's 50 of the company's money that's being used. What is that money? Well, it can only come from debt or equity, therefore it's equity money. So this project now is solely being measured in terms of shareholder money, because I've explicitly included the bond and the debt financing. So then the question becomes, for this to be a good project, what do I need to return on that equity money? Well, if I go back to the problem definition, our shareholders wanted 18%. And so if I've now turned this project around to measure it just in terms of equity investment, I better return 18% on that number. I don't have to worry about the bond now because it's totally included in my cash flow analysis. And as I say, I'm going to get the same answer, right? Because whether I use the cost of capital, which is all inclusive, or explicitly consider the bond, I'm doing the same thing. Okay. And so $53,000 is the value. This is more complicated unnecessarily. And as engineers, we don't care about how the project's financed. Just give me the $100,000 and I'll make it happen. And so, while this might be more complete in terms of cash flow, we never do it that way, or virtually never do it that way. we always simply consider what are the operating cash flows. And everything to do about financing is simply in this number, that if we're in a larger corporation, we get from the finance department. If we're in a small company, well, it's, it's the owner, if we're self-employed, we know that number, because we know where the money comes from. Okay, so we look at it from that point. So this is the approach that you should take in any of the problem analysis. Yes, is that okay? Okay. I want to now talk a little bit about, I guess, my last topic. I think we've touched on this a couple of times throughout the course. In terms of the options when it comes to acquiring equipment. Now, we don't care, really, whether we own the equipment or whether we have the use of it through a lease. In the end, as far as our engineering project is concerned, we got it. We have profitable opportunities for it, and therefore, it doesn't matter. It's purely a financial decision, as I'd like to show you. Now, you might think, well, leasing, there's some magic about leasing. People think, oh, leasing is always better. Okay. But think about yourself, think to yourself in terms of, well, what are the costs that a company bears if they buy it? Or what are the costs that a leasing company bears if they buy it? Aren't they the same costs? They got to buy the same machine, right? They got the same salvage value. They got to find money to finance it. And that there really doesn't seem to be any major advantage to a lease. Because both the lessor and the lessee basically face the same costs. Okay? Think about where that difference comes from. There are two types of lease. One is the operational lease, which is simply renting stuff for a short period of time because you need it to fill an immediate problem. Sometimes when we have a really bad networking problem at the college, we don't have this $75,000 piece of equipment that we need to really test. So we go out and lease it for a few days, find the problem, and return it. The leasing company makes their money by leasing it out for a small period of time to many, many different customers. Right? That's the business model. That is considered an expense item, as far as the, not a university, but if you're in a publicly, or if you're a public company, that's an expense item you get deducted. That's not the sort of lease I want to talk about now. The lease I want to talk about now is what we call financial lease, and it's basically a direct alternative to owning. So we're going to lease it for the entire economic life of the machine, or we're going to say, well, let's buy it instead. Let's see which one makes the most sense. Okay. So it's a direct alternative to ownership. And the interesting thing is that it looks a lot like debt. Now, you might not think that, but think about it in terms of the commitments the company has to make. Okay. Well, we have these fixed payments that have to be made, and if we don't make them, who owns the asset? Well, the leasing company. What happens? They come in and they seize it and repossess it, which puts our company perhaps out of business if it's a key asset. So it has this notion of risk associated with it, much like debt. Okay. So the deal really is, you sign up for the lease, there's a periodic set of payments, you don't own the asset, you simply return it at the end, and the salvage value reverts back to the leasing company. So it's quite a straightforward arrangement. The other option is simply buying it. Well, we did that last day in terms of the buy option. Okay. So how are we going to evaluate this? So it's a purely financial thing in the sense that our equipment is more or less the same and we can accomplish the same project goals in terms of revenue. So we just want to minimize costs. So given that the project is worth doing, let's just look at the cost side and say which one minimizes costs. That's going to maximize the present value or the profit of the project. Well, the buy option, as I said, we did last day, on Friday. And here, we're simply going out, buying the asset, raising money through both debt and equity, and we have a cost, which we put up here. We're going to value then the project in terms of acquiring that asset from shareholder money. Okay. We are going to maintain the same debt equity ratio that we normally do to minimize the cost of capital, and we're then going to be able to depreciate it because the company owns it. And we're done. So it's a standard amount. With the lease option, all we're doing is basically paying a fixed amount each time period, every month or every year, depending on the lease. And we are committed to make those payments just as much as if we had borrowed money and we have to pay interest on it. So really, they're a form of what we call leverage. Remember, this leverage is a notion of borrowing and having a set of fixed costs, and with those fixed costs, generating variable revenues. So if your revenue goes down, you don't have enough to cover the fixed cost. That's leverage. Well, the lease is every bit as much as debt when it comes to leverage. So it depends on who you are in terms of whether you're comfortable with what leases or not. If you're a debt holder, you really don't care because you have the ability to force the company into bankruptcy if they can't meet your interest payments. The leasing company doesn't really care because they'll make the payments, they're going to take back the asset. The folks that care are the shareholders. Because the more leases you have, the more likely you can't meet those commitments, the more likely you put them at risk. So it's really a hidden form of debt. And when you look at financial statements like we did in Chapter 9, you've got that debt-equity ratio. And I can have two companies, both have the same debt-equity ratio, but one be much more risky. The riskier company will have a whole lot of leases, which the accountants haven't figured out how to include in the debt-equity ratio. There'll be some notes at the end of the financial statement saying the company has these lease obligations. That'll make the company far more riskier than a similar company that has no lease obligations with the same debt-equity ratio. So it's a real problem in terms of trying to figure out, well, what is the true obligations each year of the company? Well, it's both interest and lease payments. And so you have to get a sense of that. And again, there are footnotes in the financial statements that will help you with that. It's 100% financing, which is often really good for startup companies. Go to the bank manager with a startup company and say, I need $1 million to buy my assets to get going. And the answer will probably be, no, absolutely not. You have no collateral, you have no track record, why would we lend you any money? But you might be able to secure the equipment on a lease basis. Why? Well, on a lease basis, the leasing company still owns the equipment, and they can come in very, very quickly and repossess it if you can't make the payment. Whereas the bank lending you the money has to force you into bankruptcy and get the money through that process and perhaps share what's left over with other creditors. So for risky situations for startup companies, financing is not possible in leasing them, simply because of the much lower risk associated with the leasing company actually owning the equipment that's there and being able to do something very quickly when things go wrong. Okay? So oftentimes that's the only way to acquire assets if you're a small company or if you're a risky company. Okay? Again, we don't care which option, it's purely a financial. So what I'd like to do is briefly talk about the lease versus buy option. I'm not going to go through these slides because they're much the same as what I talked about previously. What we want to do is look at a lease, and so we have got two components, the lease itself, and we have maintenance associated with the asset. Okay. Now, oftentimes the lease will stipulate that you have to keep it in a certain working condition, because if you don't make the payments, the leasing company wants to go in and have a machine that actually works. And so in this case, we've got a 5-year term, lease payment before tax $46.20, and the maintenance associated with the machine that the contract stipulates is $7,000 a year. Okay. That's what it looks like before tax. So if I wanted to ask the question, well, what is the after-tax cost of a lease? Well, if I have it in this way here, I'm just going to talk about the lease. Okay. So if I have 5 payments, okay, then the net present value of the lease is going to be, since we don't own the asset, right, so we can't depreciate it, it's a pure expense. So it's costing us 60 cents on the dollar. So in this case, I've got a lease payment of $46.20, and I've got 5 of them on common cost, and you're done. That's the present value of the lease cost. Or not cost, I suppose, it's a minus number. I guess I need a minus here, don't I? Because it's truly a net present value. It's a negative number. Okay. Now, oftentimes, lease, and this is now with end-of-year payment. Okay. Now, oftentimes, the lease requires a payment initially. So, get the equipment at the beginning of the year, and they want a payment immediately. Okay. And this really helps, I guess, explain the nature of the tax savings associated with an expense and the expense itself. Because right now, we always assume that all the cash flows are at the end of the year. When you pay your taxes at the end of the year, you get the tax savings immediately. Okay. And, sometimes just using the formulas, you forget really what's going on. Well, this forces you to think about it. Let's say, on this lease, that So this is end of year payments. Let's say the company will lease us it, but wants beginning of year payments. Does that change anything? Well, present value is going to go up, right, because we have to pay sooner. Now, think about, so end of year 0, 1, 2, 3, 4. Okay. So that is going to be much like this. So net present value. Let me hold off on the taxes for a second. 4620. Okay. So I'm going to say minus 4620. I'm going to say P given A, I comma 5, right? And then I'm going to have to move it forward once. F given P, I comma 1. Okay. So that's going to be the net present value cost of the lease itself. Okay. But now think about the tax side of things. If we pay taxes at the end of the year, then if I make this payment on January 1st, I think I valued it correctly here. But I'm not going to make my tax payment until the end of the year, December 31st, which means the fact that I had this expense, I won't see the tax savings until December 31st. So the fact that I'm paying my taxes each year gives rise to the tax savings of the expense, right? Which is T times 4620. Okay, so on January 1st, I give the leasing company 4620. I then fill up my tax forms on December 31st, claim the expense item, and save the taxes. So if I'm trying to value this properly, the tax savings are delayed. So this is a minus, that's a cost, and the tax savings then becomes simply T 4620, P given A, I comma 5, with the beginning of your payments. And more than likely, a lease arrangement won't allow you to make a payment a year from when you receive the equipment. It's usually due upon receipt of the equipment. Okay. So that then decouples the tax savings from the actual expense. This formula implicitly says everything happens at the end of the year. So I make my payment, I get the tax savings immediately. You need to then consider when that's not the case, you need to bring it in. Is that okay with that? Okay. So that's the lease side of things on an after-tax basis. Okay. On the buy option, we talked about on Friday, very, very straightforward. And so we're buying the asset. Because the company in this auction owns the asset, they get the salvage value, right? Notice in the lease, there's no salvage value. At the end of 5 years, it goes back to the leasing company, it's theirs. As well as, because the company owns it, like we talked on Friday, tax benefits of depreciation occur to the actual leasing company. So that's all part of the price that they can afford to sell it or to lease it to it each year. Okay. So, but on this side, if we're buying it, it's a standard analysis. Now, I'm not going to go through all of these cash flows. This is the tabular way that I was suggesting is not the best way of handling an after-tax project analysis because there's just too many numbers. Okay. And so what I recommend is simply valuing it in terms of equations like that, where you can actually, very, very quickly come up with the value of the project. Okay. And so that's just the least component there. And the buy option, quite straightforward. This is the tabular approach. On Friday, I suggested that the so-called elegant approach, where you're using the value, the actual formulas to help value each one of the components, is far simpler. If you decided to use the tabular approach for this, you would have all of these calculations to do. Indeed, all of these net cash flows are different each year. You'd have to present value them to come up with the total present value of this project. Much more cumbersome way of doing this. Okay. Whereas, as an exercise, you may just want to do this using the elegant method and hopefully come up with the same answer. It would be a lot less work. Okay. The tax savings are very easy to come up with the geometric series formula, and the cash flows are basically usually an annuity type operating income formula. Okay. So that's reasonably straightforward. In this example, it so happens that, and these are the differences, cash flow diagrams sometimes give us a really good idea of what the difference between the options are. The key difference, of course, is that with the lease option, and this is lease versus buy, so the benefit of the lease is simply a positive number. The obvious reason for going with the lease is you don't have to use the company's money. It's 100% financing. So in this particular case, you're not spending $18,000 on this machine. That's where the benefits stop. From there, you're basically paying the lease, you're not getting the depreciation, you're not getting the salvage value. It's a pure financial decision to trade off these future expenses versus saving the company's money up front. Okay? And in this particular case, I do a net present value. And again, here I'm using the tabular approach. So I've got to actually do present value on each one of these cash flows for each of the 5 years. It's a lot of work. The formulas would do that very, very simply for me. I come up with a minus of $1,400. In this case, the network router should be purchased. The big difference here was that if we maintain it ourselves, we could choose it. If we bought it ourselves, we could maintain it at whatever level we want, and we could have cheaper maintenance. Basically, the costs of the lease or owning it might by and large be the same. So, key thing here is, with the lease option, we don't own it. Therefore, we don't have any depreciation. There's no salvage value. Most leases have a beginning of year payment. Therefore, the tax savings occur at the end of the year. The payment at the beginning, you have to break up the tax savings from the actual lease payment itself to value the property. Then with the buy option, the company owns it. Therefore, the normal analysis for CCA and salvage value included is part of that analysis. So rather than just talk about these numbers on that point. Any questions at all? I know I'm covering a fair bit of stuff. Okay, I want to now just talk a little bit. This is there are two tax loopholes that I've got here, and one of them involves a private individual. Okay, that's the second one I'll talk about next day. This one, and I just want to go through it just to give you a sense of why people might want to do this. This is nonprofit organizations. Nonprofit organizations like the University of Toronto or hospitals can, or used to be able to, basically arrange their affairs to minimize the cost of owning buildings. Now, as we're going through here, think about why would anyone on earth want to do this? Where's the possible benefits? And secondly, how is the leasing company making money? This refers to taking a building, okay, and basically selling it to a leasing company, and then leasing it back from the company. There's absolutely no difference in terms of the University of Toronto. Now, I should start off by saying the University of Toronto did not engage in this practice. We didn't think it was the right thing to do. You know, Queen's Park is so close to next door here that we figured, well, we keep on their good stuff. So we didn't do this. Okay. But many hospitals and other universities did do it, and the federal government finally did decide what to do about this, and we'll talk about that a little bit. So think about the deal. It's really silly when you think about it. Sell Robarts Library, okay, to a leasing company for $25 million. Lease it back for 25 years. And then basically agree to pay a lease payment each year. And then buy it back 25 years from now for the same price. Okay. Is there any difference as far as our students are concerned? Absolutely not. The only difference is that in a computer somewhere, rather than the governing council of the University of Toronto, there is the leasing company's name as the registered owner of the property. That is the only difference. The chief librarian still runs the place, facilities and services still cleans the place, the students still use the place. Okay. So there's no difference. Okay. Now, is there any risk to the University of Toronto here? Well, the only one really is if the leasing company was bankrupt. They own Robarts now, and we may have trouble getting it back. And he would say, well, does that really matter? Possibly not. But, so we have to be careful to monitor the leasing company or find one that's really, really financially sound, so that the probability of that's going to happen is very, very small. That is the only risk to the University of Toronto. Now, the leasing company wants to make money at this. This is not a charitable donation as far as they're concerned. We're going to make money, they're going to make money. And ask yourself, who's the loser now? Well, let's say we've got this deal, and so now I'm going to basically look at the value. Let's say the leasing company charges us $2.5 million a year. Well, that's the very least that they could charge, is it not? Because they had to go out and borrow the $25 million, and they have to pay 10% interest. And this is not a charity as far as they're concerned. They want to make money. So the very least they have to charge us $2.5 million a year. Well, what are we going to do with the $25 million that we get? We're going to put it into the endowment and assume to make 10%. Okay. So as far as we're concerned, if we have to pay $2.5 million a year, there's no benefit, right? We put $25 million into the endowment. We earn $2.5 million a year worth of revenue, and we give that $2.5 million to the leasing company, and then we give them the $25 million back 25 years from now. Net present value, that's zero. Right? We earn $2.5 million, we give them $2.5 million, and it doesn't work. It's not worth it. So if the leasing company, and it seems that they need to ask us for $2.5 million just to cover their financing costs, it makes no sense. What about if the leasing company can charge us less and still make some money? Okay. Let's say they are going to say, okay, we're willing to sign the deal for 25 years. U of T, give us $2 million a year. Well, that's now really neat, because there's no change as far as our students are concerned, and we're making $500,000 a year on that one building. We've got, I don't know, 150 buildings. So if we could make $500,000 on each a year, well, that would be quite a sizable set of revenue for the university. Is this worth doing? Well, two ways of doing it. One is to do the cash flow analysis. Okay. In other words, $25 million. Then we have $2 million going out, and $25 million a year, and then $25 million going back to buy reports. $4.5 million. The other way of looking at it, what's the benefit to U of T? Well, are we not earning $2.5 million a year on the $25 million? And are we not paying a $2 million lease payment? The net $500,000. So hopefully, taking the present value of 25 years of $500,000 a year is the same answer. So the value of this deal is $4.5 million present value to the University of Toronto. We're earning 2.5, and we're spending 2.3. And the leasing company is making money as well. But how can they possibly be making money? Because they're losing $500,000 a year in financing charges, right? Because they have to pay $2.5 million on the $25 million they borrowed to give to us. Well, this is where the tax act comes in. Remember the term depreciation tax savings. It's written up here. If you're a university, you don't pay tax. Therefore, depreciation has absolutely no value. What about if you transfer the asset over to a company that's paying lots of taxes? All of a sudden, they can depreciate it and save tax. So all this is a clever mechanism to transfer depreciation that's actually worthless to the University of Toronto because we don't pay tax, to a money-making company that pays lots of tax. By having Robarts, they pay less tax, and they share that with us. That's how they can give us $500,000 less. This is how it works. Look at the leasing company's point of view. Okay, well, in the first year, we give them $2 million. That's the lease payment. They have had to go out and borrow $25 million to buy Robarts from us. At 10%, they have to pay $2.5 million worth in interest charges. They are losing $500,000. After tax, remember, a loss or a profit works both ways. I'm assuming a 50% tax rate to make the numbers easy. Their after-tax loss is $250,000. What about depreciation? Well, if you calculate the depreciation on a $25 million building, the tax savings is $312,000. So what's absolutely worthless to the University of Toronto is worth $312,000 to this leasing company because they own Robarts now. And with the half-year rule, it gets even better next year, when the full 25 million goes into the leasing company's book. $609,000 worth of depreciation. So it's simply a clever way of creating value from depreciation where it wasn't valuable before. So, why does it work? Well, it works because over the 25 years, there's millions and millions of dollars worth of tax savings. One way of looking at it is, if the leasing company owns Robarts for a very long period of time, I can use the capital cost tax factor, and I've got $4 million worth of tax savings. Okay. Then take away the tax savings from year 26 up to infinity. Remember, capital cost tax factor is zero, sort of all the way up to infinity. I'm going to look at the book value. So 25 years from now, Robarts on the books is worth $7 million, okay, which means the leasing company loses the depreciation from years 26 out to infinity. Okay. And because when they sell it back to U of T, the book value is $7 million, and they're selling it back to us for $25 million, there's depreciation recapture. Remember when we talked about it, when you actually dispose of the asset at the end of the project, there's recapture, there's capital gains or terminal loss. Well, in this case, the selling price is greater than book value, and they need to pay back almost $9 million. Okay. But remember, they got those savings for the entire 25 years. Present value of that significantly more than paying $9 million worth of tax 25 years from now. Indeed, 25 years from now, it's not worth very much. Okay. So the whole idea was to basically take those tax savings and then pay it back 25 years from now. The Tax Act allows this. It's perfectly legal. This is simply tax avoidance. Well, let's put it all together. Okay. So, Robarts depreciation, if leasing company owned it for a very long period of time, $4 million. They sell it back to us 25 years from now, so they lose a little bit of depreciation from years 26 out to infinity. They have to pay back the depreciation recapture at that time, which isn't worth very much. So the total deal to the leasing company is worth $3 million. Okay. Present value of the tax savings. Okay. What is that worth per year? Well, that is, if I turn the $3 million into an annuity, that's worth $334,000 to the leasing. Okay. Well, that, together with their loss, basically is $4 million. So, for simply setting up the transaction, they receive $84,000 a year. They don't do anything other than cash our check once a year. It's really sweet money for them. So, of the total savings, okay, remember, we're getting $4.5 million. They're getting $0.77 million. They don't do anything, and we don't do anything. Okay. But we both benefit. Who is the loser? The government? Taxpayers, exactly. Okay, but how can you argue with flowing more money into universities? If we did this for all 200 buildings, could we not reduce our tuition? Well, we could. Would we? I don't know. This is a good social thing, isn't it? We are reducing the cost of running universities, which is a socially responsible thing to do. So who could argue with that? Anyone in this room? What do you think?
I think you talked about it before, but I didn't really understand. What happens if the leasing company does go bankrupt?
Then we are in trouble. We have to make sure that we have a clause, get some really good lawyers to write up the lease arrangement, so if we sniff any trouble, financial trouble, we get in, it's null and void. That's the best we could do. But, you know, we would then have a claim against the company along with everyone else in that case. Okay? So there's risk there, without a doubt. Okay? But think about now, what's this doing? This is funneling taxpayer dollars into education, which by itself is a good thing. But who have we elected to decide how much money universities get? Well, the folks over in Queen's Park. Are we not doing something that totally bypasses their authority, where they say, you know, we put $2 billion or whatever into education, well, now we're taking more. doesn't Queen's Park have other obligations for health care, social services and that still requires the money. So what we're doing is taking more than the government has allowed us in terms of funding through this mechanism. Okay? And that, of course, bypasses their authority in terms of them being elected to decide how they slice the pie in terms of government revenue for all of the needy services that Ontarians want. So, first thing that happened when this hit the Globe and Mail was across the street there, I'm not sure where Queen's Park is here, but wherever it is, the minister stood up, Minister for Education, and said, it's come to our attention that certain universities are doing this, and we immediately are reducing the operating grant of every university to the tune of the benefit of whatever financial arrangements they've made through these. So all of a sudden, it's not useful for universities anymore. And that person could do that because he has the authority to figure out how much each university gets. Similarly, the Minister of Health goes up and says, we are going to do the same thing for every hospital that's done this. So all of a sudden, there's no benefit. They weren't happy that more government revenue was being flowing into these areas more than they had decided. Finally, the federal government basically strikes down this loophole. And they say, this doesn't make any sense whatsoever. And what they did was they said, you can do this if you want, but the lease has to stand by itself. The reason that this worked in the U of T case was the leasing company was profitable on other business and used it to reduce taxes from other businesses. The way we structured this lease says, you're not making money if you get $2 million and you're spending 2.5 on your loan. So what the government said was, you can make the lease stand alone, you can do it, but these leases only work if you can use the depreciation on other income. So this loophole has been absolutely closed. Okay, and I think socially it was a responsible thing to do. First thing in the morning, I'm going to give you another set of another tax loophole where the government didn't vote, and it really looks like they should have. We'll talk about why they didn't. No, talk about